term insurance versus emergency fund. What is the difference? And
yeah, it's a very important aspect again. This emergency corpus comes in case of
if I want the money immediately, like for the next month, how easy it is to redeem that money from liquid fund and to my saving account?
It is just 24 hours, one day liquid.
I'm ready to invest 15,000 from the next month. Give me a rough number. Like if I'm starting in my 40 years,
you can take two approaches to this thing. 15,000 rupees can be done in a step-up model also.
Fund return is let's say 18%. What is the investor returns? Every finance content creators, finance experts, they are saying like 12%, 12%, 12%. So I just wanted to know why the 12%.
What is the possibility that we can earn from here? So when you are looking at this thing, then you have to understand your country's growth rate, and inflation is the other one which has to be added to this. So we can always say 22%. Your Excel numbers may show higher return. The projections may know higher return.
Hi all, welcome to the channel Rich with Ram, and I'm your today's host. So today we are going to discuss with Ramakrishnan sir. He's a certified financial planner and wealth manager. He's been financially guiding over 1,600 families. Sir, welcome sir. And thank you so much for having me as your guest, sir.
Namaste.
Namaskar sir. Sir, first thing I wanted to ask is like, there are many people in the comments that are in 40s, they are asking like, sir, these days like almost I have wasted 20 years and if I would have known like SIPs and SWPs, I would have started investing in my 20s. So today's topic is completely for those people who are in 40s, who miss their 20s, 20 years they have missed it. And usually we used to say like, okay, if you start early, you will be like building your wealth, more wealth. So I want you to give me a plan for those people who can, able to do a monthly SIP for 15,000 and all. And before going into investments, do you have any advice for them? Like what are the things that they have to do before investing in SIPs?
Yeah, it's a great question. Generally, we see a lot of individuals have this particular kind of regret that they have not used the right time. Means they have not started on time, or they have delayed, and it is very common. They always keep saying that I should have started this 10 years back. I should have met someone like you about 15-20 years back. This kind of. But at 40s, if you observe, they may be having some young kids. Generally, say 10 to 15 years kind of kids, one or two, based on their family size, and family will be dependent generally. If both husband and wife are working, it's okay, but if they are not working, these kids are almost in the school, and trying to complete their school. So the basic thing what comes into mind is they should ensure their safety first of all. Okay. That is one, when we are talking about SIP. Okay. The goals are also taking priority. The goals generally are that kids education, which has to be considered. Then in case something happens to the breadwinner, suppose he is the only breadwinner and he is the only source of income, then there is a risk, financial risk. Suppose if the breadwinner is not there, how the family will survive, how the wife will manage the family, how the kids are going to go complete their education. This is a big thing. So for that some kind of risk management by availing right kind of insurance is required. Other than that, they should provide for this, and then they can start with SIP. They should not be any problem.
Okay, so you were saying like before starting investments and all, we have to have our security. Like there are some things like some other creators used to say like emergency covers, and I want our viewers to understand term insurance versus emergency fund. What is the difference? And if people in their 40s do they have to build an emergency fund? Is it necessary for them, sir?
Yeah, it's a very important aspect again. This emergency corpus comes in case of really unknown factors, right? Okay. There are many things which are not known to us. These unknown factors come suddenly. They don't tell I'm going to come in your life. Means it could be sometimes COVID, which came in just like that, which came in. A job loss can come in. Job loss is something which can come from nowhere, and suddenly you are at a position that you are not having income for few months. Of course, you may get another job. We don't know what is going to be the time limit. Sometimes this kind of job losses because of actions coming from abroad. A particular sector is down, that sector can go down.
And we are seeing many news like this company is actually layoffing
Yeah.
like 200 people.
Very true, very true. Even though they are not pleasant, but to be prepared for such kind of emergencies.
Okay.
Or there could be scenarios like a person met with an accident and 4-5 months he has to recover. During that time there is no income because the company which has been employing him can give him income for say 1 month or 2 months, but beyond that it may not be covered. So these are all scenarios which makes the family to struggle a bit.
Okay.
That kind of struggles has to be avoided. That is predominant.
Okay.
For that, there need to be a kind of emergency corpus. Generally, we say at least be prepared for minimum 6 months of your household expenses.
Okay.
So if a person is earning say 50,000 rupees,
okay,
and household expenses, considering his personal expenses is out of that, and household expenses is about say 35,000 rupees, 70% of the corpus. That 35 into 6, that
okay,
is about 2,10,000 should be there always as emergency corpus, which can be redeemed with minimum formalities.
So should I keep the emergency fund in like any investment angle or something, like in a saving bank account? How should I keep?
Mostly we will suggest them to keep some money in savings bank account,
Okay.
some money in liquid funds.
Okay.
Liquid funds are also very, very good instruments which are there. The difference between savings bank account and liquid fund itself is huge.
Okay.
Most of the scheduled banks today offer around 2.75% as savings bank interest.
Sure.
Liquid fund on the other hand has been offering around 5.5 to 6% annualized returns.
Okay.
So the difference is almost 100%. 2.75% versus 5.5% means 100% you are going to earn.
Okay.
What is the difference of this 100%? It can take care of one of your dinner.
Okay.
Right. So over a period of 1 year, probably you can host your birthday dinner or anniversary dinner or your kids' birthdays dinner free of cost by just planning this.
Sir, and if it is an emergency fund, like keeping in a liquid fund, is it going to be helpful for me? Let's say if I want the money immediately, like for the next month, how easy it is to redeem that money from liquid fund and to my saving bank?
It is just 24 hours, 1 day liquidity.
Okay.
We call it as T+1 liquidity, means transaction plus 1 day.
Okay. Okay.
All we have to be aware is the weekends, that is Saturday and Sunday.
Okay.
So if at all you need money by Monday, you should plan it by Friday because Saturday, Sunday are holidays. And you need to be aware about government holidays also or non-transactional days. These are the only things we need to plan. Otherwise, in almost all cases, it is 1 day. Effectively within a day, morning 10 o'clock, you should be seeing that in your account, provided you are given the redemption request the previous day at about, say before 2 o'clock.
Okay. Okay. So let's come to the interesting part. Like, let's say I can able to, I'm in my 40s and I can able to invest 15,000 per month, because I have really not say wasted, but I don't know the facts that there are SIPs and the money grows and 12% compounding interest. These are the things I didn't know earlier. Just now, there are many creators, there are many financial experts are talking about SIPs, SWPs, STPs. So I want to invest now. I want to start now. Is it okay to start early, and is it possible, to plan my retirements? Am I going to be safe in my 60s?
Yeah. See, at any day starting, even if you are at 40s, starting, you are definitely going to reach the level of safety.
Yeah.
Not starting and delaying, the chances of you reaching is going to get increased. It's just like a cricket match. You just see, you start, scoring in singles. It's fine, right? Sometimes the batsman comes, eats away, say 10 balls, 20 balls in the upfront, part of his, innings. But, then he settles. Then he starts, moving freely between, the scores starts coming in. Then he starts hitting big shots because he has set in already, right? But when you come little late in the part of the innings, all you have to do is, swing your bat.
Okay. Okay.
The later you are, then you are leaving the chances to luck.
Okay.
Right.
Okay.
The earlier you are, you have the time to set in, and then you have to hit it. That is very much easier. The same thing happens in our life. If you are looking at your own life, earlier you are, then you have time. You can score singles. Probably 1 year it is not better. Or you have to pray for the God. God, give me all years where I can earn about 20% CAGR, which is very difficult to
Yeah.
no get.
Okay, sir. Sir, let's say like I'm ready to invest 15,000 from the next month. So give me a rough number. Like if I'm starting in my 40 years, how the money would have been grown by the end of 60 years? Because I'm planning to give 20 years. I'm going to be committed for the 20 years because I have to plan my retirement. Because in 60s I can't be able to rely on my children to give me month some pension every month. Give me some money for every month after 60s. It's going to be a little bit difficult for them too, and it's going to be a little bit difficult for me too in my 60s because I can't able. No, it's like burdening them with monthly commitment. So give me a number, sir. Now.
Yeah, it's a very interesting question. So you can take two approaches to this thing, and you are now saving every month 15,000 rupees for a period of about 20 years.
Okay.
And if that happens, then your maturity corpus will be about 1.48 crores, assuming 12% return.
Okay. Okay.
The second option which you can take is this 15,000 rupees can be done in a step-up model also. Okay. What is step-up model? Every year you get increments. The incremental portion can go to saving, can go to spending, right? Okay. If you are good enough to increase the increment amount towards your savings or investments, then the advantage you get is that much corpus gets increased. Okay. So this method is called a step-up in SIP. Okay. Assume that you are stepping up your SIP. That means increasing your SIP by 10% every year. Means you are starting at 15,000 rupees. The 13th month, you are going to start with 16,500.
10% of 15,000.
Yeah, 10% of 15,000. 25th month, you are going to increase that 16,500 plus 1650.
Okay, okay.
Right, that if you are doing it for 20 years considerably, your maturity corpus will be something close to 2.98 crores.
Okay, okay.
Against 1.48 and 2.98, the difference is double.
Yeah.
All you have done is little more effort by just stepping it out.
Okay.
So this corpus is going to be huge, and that 2.98 crores can very well work for your retirement, and it can ensure that you have a peaceful retirement.
You told me like we are going to be conservative, so we take 12%. Is it possible, or even in the history, is there any fund that have? I don't want the fund name because we don't have to recommend the fund. I just wanted to like have an idea that is it possible that is there any fund that has given more than 12% in the industry, like in mutual funds?
Lot many funds have given.
Okay.
If you look at the equity, diversified equity funds,
okay,
most of the funds over last 20 years would have given definitely more than 12%. There could be one or two funds which would have missed that thing. And aggressive hybrid funds, that means funds which predominantly invest money into equities and a smaller portion into debt.
Okay.
Those funds also would have given about 12% per annum. Lot many funds are there within the category, and they are making it. In fact, if we take the risk level little higher, that is from the diversified equity fund, you move to say a mid cap fund or a small cap fund, the chances of you earning higher becomes better. So if you add few of the schemes within your portfolio into these schemes, your chances of earning little higher also goes up.
Okay.
But in any case, it is always better to be conservative,
okay,
rather than taking aggressive calculation. So 12% is a good amount.
Okay. So mainly the reason I asked this question is, I think yesterday for the content research, I've been looking into some 30-year-old funds. Their CAGR is around like 22% for the 30 years. I was a little bit shocked because every finance content creators, finance expert, they are saying like 12%, 12%, 12%. So I just wanted to know why the 12% that every finance expert is saying. Like, and they are, I know they are NICM certified, AMFI registered mutual fund advisors, finance experts, financial planners, but everybody is going with the 12%. Actually, why the 12%? Is there any rules or something like that you have to say 12% something?
Yeah. See, one is AMFI gives a broader guidance. Okay. They say what was your past performance over a period of say 10 years kind of thing. Within that limit you speak. So past 10 years kind of performance on rolling returns at most of the time will be around 12.9%. So it is better to be conservative.
Okay.
The second aspect to look at is what is the possibility that we can earn from here. So when you are looking at this thing, then you have to understand your country's growth rate and what is the probable inflation.
Okay.
So country's growth rate is your GDP growth rate, and GDP growth rate, most of the experts predict, around 7% per annum. Some of them predict 6% per annum. So let us assume that it is between 6 to 7% per annum.
Okay.
And inflation is the other one which has to be added to this.
Yes.
So inflation, again, it is between a range of about 5% to 6%. Assume that over a period of long run during this time. So you add these two numbers.
Okay.
So you will get anywhere between 11 to 14%.
Okay.
The mid level is around 12%. So bit more scientific way of thinking that you can look at that number. That is why 12%.
Okay.
So we can always say 22%. Your Excel numbers may show higher return. The projections may higher return. But if at all we miss it, there will be a lot of disappointment.
I have seen one post like fund return is let's say 18%. What is the investor returns? So there is a difference, right? Because sometimes investor is not capable of investing monthly, and they are not disciplined. They are not committed to it. So the fund return is 22%, 18% or more than 12%, let's say. But what is the return of the investor? So this is one post that is so much interesting. Do you often see with your client that some investors skip the SIP and something like that, sir?
Yeah. So it is a very interesting question. So in a way, you just look at this thing. Fund has given that much return, and investor earned lesser return. What that means is investor has done some action which the fund was not doing.
Okay.
Right. That means you plainly not doing much of effort, staying disciplined. You have earned say X%.
Okay.
With your all knowledge, you try to middle with that effort, and you try to enter or exit at your own choices. Then definitely the chances of earning that has gone down, and your choice of getting a compounding has gone down. So this happens for 2-3 reasons. One, people have a lot of impatience. In the sense, they look at, most of the time they look at a newspaper or a website, and they assume that, these 5-star rated funds are, the top rated funds are better. So they get into that funds.
Okay.
And in a level of, 1-2 years, most of the time, what we see is these funds, their performance come down.
Okay.
When there are higher inflows, then, that performance also most of the time I could able to sense that. So then suddenly I am not seeing my fund as again a 5-star rated fund. When I invested, it was a top rated fund, and today it is less rated. So today the newspaper says another 5-star rated fund, and I want to enter there. That means you are trying to jump the queue. From one queue you are now going into a fast moving queue, and you are not sure whether that queue will be the fastest in future. And if that is the case, then you have always you have to go by the chances. So it doesn't guarantee you the future. That means a top rated fund definitely doesn't guarantee you the next year also I will be top rated. So that is one aspect of it. The second thing is the greed and fear factor.
Okay.
So whenever things are looking bright, I just go and invest more into that scheme. Whenever things are looking little sober, then I try to stop or reduce. These are my own actions which come in. So when things are bright, then I just go and add more into that thing. See, last 1 year back, defense sector was doing very well. Yeah. So then people were all there into defense sector. Then last 6 months back, defense sector was correcting, and it again corrected a long. And people have stopped investing into defense sector. Rather, they started withdrawing, and they invested into other kind of segments. But last 2 months, suddenly there is some kind of unrest came in, and that has again ensured that the defense stocks have started moving up. Yeah. Again, there is a chance that now I want to enter into different segment, defense SIPs kind of thing. Okay. So one is you need not be there with kind of a defense stock. Just invest into a diversified equity fund. Fund manager will do it. Yeah. Even if there is a market correction, your chances of getting higher units goes up, because you are contributing the same amount if at all you are entering to a SIP route. Even otherwise, just stay invested. Market will definitely come back.
Yeah. I think people miss the chance because they tend to afraid of the situation when the market is down, because they have to. I think they have to look at it as an opportunity, because when we are going for a shopping mall or any textile showroom, we see it as if there is any offer like 20% offer, 30% offer, we tend to buy more at the time. When the same scenario replicated in the market, people are afraid, no, I'm going to stop it. I'm not going to purchase it. Because even as you said, every month I'm investing 15,000. I'm going to get 100 units for the same 15,000. But when the market is corrected 20%, 30%, I'm going to get another 20 to 30% extra units, right, sir? Am I right, sir?
Yeah, you're absolutely right. That you are going to get that extra units. That extra unit is the primary reason that you are going to get higher return compared to your normal returns, because you have stayed invested, you have seen the journey, and you have ensured that volatility is your friend. Just accept volatility as your friend. When things are volatile, invest more. You don't have that individual guts to invest more. That is why you are choosing a format or a disciplined approach called SIP.
SIP, yeah.
Again, going and stopping that means you are again making a mistake, that that this is not right kind of approach. So better just give that time for that market volatility to settle, but not your effort to settle. Your effort to win is much higher. So in fact, people should get aggressive when things are correcting, but always that fear factor comes in, because what you read, what you see in channels and all, always those are negative.
Okay.
So you start defining that okay, this there is a problem with respect to this war, that this is going to be a problem, and my returns are going to go away, and that is why I try and stop that thing. So better not to do much about it, rather stay invested with the course, or add little more if possible.
I think we have come to the end of it, because I'm going to be 40 years, I'm going to be investing like 15,000 every month. But my plan is for 20 years. 20 years I'm going to do SIP. Is it okay if I'm planning for any aggressive mutual funds? Because 20 is a long period. For any long-term investment, aggressive, conservative, or like balanced, it's going to work out fine in my belief. And I have also seen many finance experts' advices. So is it okay if I enter any aggressive fund if my investment period is 20 years?
Yeah, more than 10 years, you can look at aggressive funds, which is a very, very decent kind of thing. So if 20 years means the chance of you seeing multiple cycles of the market is higher. So the more time you get, the chance of you getting better returns also goes higher. There are a lot of studies which says that more than 7 years, people have not got disappointment in equity markets.
Okay, in any fund?
Most of the funds. Yeah.
Okay.
Most of the funds. 10 years or 12 years. There is a particular study which says 10 years or 12 years, you at least stand a chance to beat the FD return by 1 or 2%.
Okay.
So your FD return says X. Express to the chance of getting that kind of return becomes higher when you are there between 10 to 12 years.
Okay.
15 years though, you are definitely going to beat that return, despite market volatility, despite your kind of phases which you are going to go through. 20 years is a good time, and aggressive funds work much better. And
also I have another topic which we'll discuss in another video. It's for SWP. So I have been investing for 20 years. Now it's time for SWP. So I'm a corporate employee. I don't have pension. So I think in the next video we are going to discuss about like SWP. How am I getting in this same fund? How I am going to get monthly pension and all. And so thank you so much. Whenever I watch any investment related video, there is at least 5 to 10 comments. If let's say if there is 100 comments, let's say 10 to 20% of the comments are like, sir, I'm in my 40s, I can invest 10,000 rupees. So how can I do it? Give me a plan for that. So these are the comments that I see widely. So that's why I wanted to give this content for the people and ask the questions with you. And thank you, sir. Thank you.
So nice. Thanks for the opportunity. It is wonderful speaking to you.
Yeah, thank you, sir. Thank you.